not going to go back to too many of the basics. We'll do it at a high level. For those who are familiar with it, it won't take too long, and those who aren't that familiar, it'll help give you some context. Then we'll talk about how your institutions are going to be impacted by this change. A little bit about the calculation methodologies that are involved and the data requirements to support this new rule. We will talk a little bit more also about disclosures that are going to be something that all institutions are going to have to do. And then wrap up with what should you and your institution be doing now to prepare. ArdmoreFintellix Solutions, I'm the CEO, as Austin introduced us, and Sunny's the COO. Ardmore Banking Advisors and Fintellix Solutions joined as partners at the beginning of last year to deliver solutions to the small institution market here in the U.S. And Ardmore Banking Advisors has been involved with helping smaller financial institutions with credit risk data and policy issues for 25 years. And Fintellix Solutions has been developing bank compliance solutions overseas for the last 10 years. So the combination of the two of us, we think, brings a real opportunity to smaller institutions who would like a more or less turnkey approach to resolving compliance issues using technology, but also need someone who really understands the local core systems and accounting systems and data sources that you use. So that's what we represent, and we're excited to work with OnApproach to deliver our solutions to banks that use their services. So just to jump right in, and Sunny's going to make comments as he thinks are needed. He usually corrects me when I'm wrong, so he has a role here. But I'm going to lead you through this. So basically, what CECL was built to do was to address the issue of the fact that in the prior economic downturn, as I'm sure you're aware, the amount of reserves lagged the amount of losses. So as we look back and based our ALLL reserves on what happened in the past, we were under reserving for what actually happened, because as we looked into the past, we saw no problems in the past. So we applied that model to the future, and then we were under reserved. Similarly, in the second scenario depicted here, we're over reserved now, because as we look back at those losses, even though now the economy has recovered and our credit levels have improved, we're still reserving for the bigger problems of the past. So this lag has created a need to address more proactive measures around reserves, and that's really the whole crux of this. So CECL. CECL stands for Current Expected Credit Loss, which is almost sort of an oxymoron in itself, how you can be current and expected at the same time. But the idea is to be proactive and attempt to more adequately tie the reserves to actual loss cycles. And it's based on this idea of LOL, which means, in our case, life of loan loss. So LOL is not what you think it is, at least not with CECL. The idea here is that you're going to be projecting the losses for the life of the loan when the loan is purchased. So this applies to consumer and commercial, auto, direct, you know, any kind of lending that's going on an amortized basis is involved. And under this new rule, the institution is going to have to say, when I book this credit, what is the life of loan loss that I expect? And this projection of loan loss has to incorporate reasonably supportable economic projections of the future. And that reasonably supportable is in quotes because it's not defined. And one of the things you'll find as we spend the next 40 minutes or so talking about this is there's a tremendous amount of subjectivity in the rule. There's flexibility, meaning that the institution can choose from various options on how they want to reserve. But on the other hand, it has to meet the requirements of the regulators, it has to meet the requirements of auditors and external accounting firms that look at how you do your ALLL. How do you do a reasonably supportable economic projection? That's something that institutions are trying to grapple with now. Some institutions in the larger size, and I mean really large, who have to deal with Dodd-Frank stress testing or even CCAR, which is the largest financial institutions, have already developed methods to do correlations of previous losses with economic cycles. That's one of the ways that you can do it. However, just as I said, it's not the only way. It's just one of the ways. Life of loan and current expected credit loss projections aren't necessarily the same thing, and I'll explain that. The next concept we want to really talk about is what's in and what's out. So, and for your institutions, depending on your size and complexity, this may or may not apply to you as much, but basically amortized cost basis, one of the values of the new rule was to bring all of that together under one rule. So you can see there are some exclusions. Whether or not these apply to your institution, is not necessary, but basically everything that's in under amortized cost is considered part of the solution.
And just to add to that, there are a couple of other things that the guidelines cover apart from the receivable financials, as the guidelines call it. It makes changes to the way we provision for AFS securities. So that part of how we do provisioning is amended. Second, it also makes substantial changes to the way we do PCI accounting today. So for those of you who are involved with either the AFS or the purchase credit impairments, there are parts of the guidelines that amend those as well significantly.
Thanks. So you probably know the timeline. For SEC filers, it's 2019. For non-SEC filers, the smallest institutions, 2020. And then you start dealing with interim periods for privately held institutions and the like. There is an opportunity to do an early adoption, probably not something that the institutions on the phone here are that interested in, but if you wanted to, you could actually adopt earlier the CECL guidelines. So let's talk about the financial impact of this on your institution. The loss curve is very important, and I know for a lot of you that don't have a great deal of commercial lending, this may or may not apply as much, or you may not be as familiar with this, but the current loss amount that's put into the reserves under the incurred loss model that we follow today represents basically 4/4 of loss based on what you see in your portfolio. So in this chart, that might represent the green bar. Under CECL life of loan loss, depending on where the loan is in the cycle, that's the amount where you're going to have to provision for. So for example, if you're on the left side of the curve, meaning that the portfolio is largely full of new loans, you have a lot more life of loan loss that you have to calculate. Whereas if you're on the other end of the curve and you've got a very seasoned portfolio of loans, then you'll have a lot less to provision for. In any case, it's pretty obvious if you look at the yellow versus the green, you're going to have more provisions than you do today. That's why so often we're hearing about large increases, 20, 50% potentially in reserves. The way the rule is written, there is a one-time hit to your capital that will be effective only on the first time you do the reserve. So this is very important because institutions are encouraged to do their capital management with usually a minimum a 4/4 view, if not a 9/4 view. So it's going to be important that all institutions can estimate what the capital impact of this one-time hit is going to be of changing from the one methodology of computing your reserves to another. That's why, as we talk a little bit later about timelines, it's important that the institutions today start thinking about this, because you really need to know by 2019 what the capital hit's going to be at minimum. Also, if you're in an acquisition mode, and I think I just read about in the American Banker of all places, about a credit union that's looking to try to buy a savings bank, or if you're just working internally within your institutions, you have to think a little bit about the fact that now, if you acquire a portfolio of unseasoned loans, this is going to have a much larger impact on your capital than if you acquire a portfolio either through another institution acquisition or just through bringing new lenders on board to add to your lending group. It has an impact on your strategy. There's also some confusion in the financial services industry about exactly how hard this is going to be to do. We see people from the Fed suggest that this is going to be really difficult, and the Fed has actually already conducted webinars where they talk about some of the more complex methodologies that can be used. Conversely, the FDIC actually made a statement a couple of months ago that this shouldn't have a big impact on you, that you can use pretty much what you do today. So there is confusion in the industry, and it's understandable. And I could add that I was at the Risk Management Association annual conference really about 2 weeks ago, and the FDIC representative there said two things that left everyone looking at each other. He said, we at the FDIC believe that for a smaller institution, it's quite likely you can use your current credit structures and processes to support CECL. It's scalable. But you need to start now preparing, because it's a big change. So we all looked at each other going, well, wait a minute, if it's the same as it is now, then how is it a big change and how do we prepare? So there's definitely confusion in the industry, and we're going to try to bring you our view.
We did last year, we did a cost-benefit study for the new guidelines, and we presented the results of that in a study to the OCC team. The chief economist of the OCC was also present during our analysis presentation. And I don't know, Peter, what you took away from that discussion, but my sense was the reality probably is going to be somewhere in between the people saying that this is a very minimal change as compared to people saying that all hell is going to break loose. So we'll see as the guidelines and their interpretations evolve over a period of time. But in all likelihood, the reality will probably be somewhere in between, with institutions that start preparing early having a definite advantage.
Yes, I think from what we've seen, it's not the sky is falling and everybody's going to have to go fork out $50,000 to buy a system. But on the other hand, it's not going to be as simple as just doing what you're doing now and adding a projection on the end. One of the advantages of OnApproach is that if you work with OnApproach, your data, which is what's really key to this whole thing, that's what we're going to talk about for the next 10 minutes or so, is already going to be in a place in a data mart, in a data warehouse in OnApproach that can then be leveraged to do these calculations. If you're not an OnApproach client, then you're going to have to build your own data warehouse, your own data mart to feed CECL. So either way, it's going to be a change, whether it's going to be a wholesale change that's going to cost you a lot of money and time, or whether it's going to be a tweak with some additional data management. That's going to be determined a lot on the institution by institution basis.
Okay. I agree.
Okay, so one of the things that the rule says is that an institution has to consider all relevant available information when they do their loss projections. So that would include what's going on in your portfolio today, what's happened in the past, and what is a reasonable, supportable forecast. And that could include external information, internal information. There are some statements in the rule that it may not require you to go out and find something that's not, quote unquote, reasonably available. How that's defined, I don't know. And that you may find you do have the information that you need, but it needs to be adjusted for current specific characteristics of the assets and other things that we're going to talk about. So it is a data-intensive process. We believe that the impact is going to be a lot on institutions who are going to be asked to change the way they pool their assets. And we've already heard from, for example, KPMG is an external auditor used by a lot of community banks that says they totally expect their banks to start being more risk-oriented in their pooling structure, not just doing it by, whatever kind of call codes or regulatory coding, that they need to do risk characteristic management. So what are those risk characteristics that you need to be worrying about now and be worrying about for the future? Well, right from the rule, it says that you need to consider adjusting your historical credit loss, which is where you start, to do your projections, to consider financial characteristics of the borrowers. And you can see some of the items here: credit rating, credit score, due to the particular asset type. And this would be looking at your pool of, let's say, direct or indirect, or other consumer, retail, or commercial loans, and looking at characteristics of how the asset performs over time, including prepayments. Something you may not be worrying about now, but under this rule, it wouldn't make a lot of sense if you have a 15-year mortgage to do a 15-year projection of losses when under prepayments it actually is an average of 9 years. So if you can prove that you have prepayments that the average weighted age, let's say, of the asset is 9, then you can do a 9-year projection instead of a 15. So there are things to think about. In addition, the Q factors, or those qualitative factors that have to be included, could extend into institutions, processes, and procedures and standards, as well as environmental factors. And this would have to factor in projections of what could happen to the economy based on the best information you have available. And bear in mind, all of this has to be audited. All of this is going to be looked at by the regulators. When you don't have a supportable forecast, you're supposed to forecast as far as you can and then revert back to your typical credit loss or term. There'll be no further adjustments to that historical loss rate. So the problem for some institutions, of course, is they haven't been retaining loss rate information over the life of multi-year term loans. Where are they going to get that data? In the rule, it says perhaps you'll look at other peer entities that have similar assets. Perhaps you're going to purchase an external third-party database of loss information. There's a lot of different ways, and again, as we mentioned, this is really up to the institution on how they want to do it. So with that in mind, let's also take a look at the sort of calculations that need to be done. So the typical process for an institution is going to be first to review their pooling to see that they're incorporating risk characteristics into the way they structure their loan loss reserve pools. So if your institution is very, very basic, very homogeneous types of assets and small volumes, you may not have to change your pools at all. Unless your auditors tell you that that's what they believe the spirit of the rule is and that they want to see you do it. That's the kind of comments that we've been seeing out of some of the accounting firms now. But so the first thing to do is look at your pools and decide, are they really reflective of risk enough? Then you have to come up with your historical loss rates, which could be either loss rates or probability of defaults, depending on how you want to measure your losses. Then you have to come up with a reasonable supportable forecast for these assets and pools, and either build them into the loss rates and or create adjustment factors in your ALLL to reflect that. And then once you get past the reasonable supportable forecast period, revert back to your loss rates for unavailable information. So that's kind of at a high level what you're going to need to do. And again, if you have questions, please do fill out your question panel, and we'll try to address them at the end of the discussion.
A couple of quick comments that I just wanted to add. As far as the pools go, I think one of the things to keep in mind is the granularity of those pools. So if you believe that you have a relatively homogeneous portfolio, how much do you want to segregate that further is a question that I think would require some attention. It may not be the case as of now, but going forward, it may be necessitated that you have a look at it. That's one part. Second, I think as far as the forecasts are concerned, we have plenty of sources that are available even today. You can refer to the forecast that local feds provide. Even the CCAR scenarios that come from Fed, they have projections as well. So you can rely on some of these projections as far as your supportable forecasts go. Of course, the hard part is how do you mash up your losses with those forecasts? And that's one thing that your institution obviously has to do by itself.
Sure, and we'll talk about data sources in a minute, about some data sources that institutions can use. Just to give you an idea on calculations, I'm not going to go into this in depth. I'm not an accountant. I can't even account for myself. I'm not going to account for your institution. But you can see here the current methodologies, the historical loss rate and migration are what are used today. In addition to those, 4 other types of calculations of loss are considered acceptable in the rule with their examples in it. I do encourage you to read it. It's a long rule. Perhaps you'll skim some of it and get to the back where they give examples, but it's important that you do. As well, the Fed did put out an accompanying document that summarizes what they think are the key things that you might want to take a look at.
I think it also probably helps to know that the standard was written keeping in mind vintage analysis as the approach that would be preferred by many financial institutes. So when you read the standard, if you do, it might help to know that it was written keeping in mind vintage analysis as the preferred approach. As we go forward, we'll also talk about disclosures, and you will see that even the new additions in those are in a way based on vintage analysis itself.
Right. Vintage is something that clearly was intended to be a way you could do this more easily by aggregating data by origination date. However, the feedback we've been getting from the industry is that they're probably not going to go vintage because it's pretty different from what they do today, but we'll see. Here's an example of a calculation, just real quick. This is all the math that we're going to do on this call. And that is that if you see on the left side in the gray, the current incurrent loss of a pool might be calculated this way, which would be, you can see maybe a call code or a regulatory code balance of the pool is listed for the 8 years, and for each year there's an annual loss amount. So based on that, you can see that a calculation is done to create an annual loss rate for the pool. And you can see that the way we do it now, if we're going to do a loss rate based incurred loss model, we would take the average loss rate over that 8-year period, which in this case is 0.29%, plus we would add Q factors for whatever current factors you have to consider, which would be things like changes in the bank's policy, the current economic environment, portfolio mix, regulatory environment. So you might start out with a 0.29 for the pool based on the average of those 8 years, and then add a 0.50 Q factor summary for all these different factors. Come up with a 0.79, you multiply that times the pool balance in 2020, and you get $23,000 worth of reserves. Now under CECL, on the right side in the yellow, in this case, you're going to actually sum up all the losses for the 8-year term of the loan. And that's not the average, it is the sum of it all. And that obviously comes in at a much higher percentage than the 0.29. It comes in at 1.43. In addition, these projections have to be added in, which are additional Q factors or loss factors per pool, which would be forecasts reflective of economic measures such as unemployment, real estate. You might come up with more like a 1.76 when you multiply times the pool balance. You can see it's more than double what the other calculation is. So now this is just representative. This is not necessarily the only way to do it, but we thought it might be useful to get an idea.
Do you think, Peter, this could be a preferred approach for many smaller institutes?
It may be.
Simpler?
It's simpler in some ways.
Similar to what they do already?
It is. However, you have to add not only the life of loan loss, but you have to add the projections. So is that simpler? Let's just put it this way. I think it's going to vary by the portfolio mix of the institution. I'm also showing here a vintage analysis. If you're not familiar with vintage, the idea here is to take credits that have a similar asset risk characteristic and lump them by year of origination, and then do projections, which is represented in the pink, for what you don't have for the life of loan loss. And then you create the totals and create a vintage by vintage pool. The advantage of this is probably less pools, at least because you don't have to break it out by all kinds of different asset characteristics, because the idea here is the year of origination bakes in the economic situation. And we talked a little bit about things to consider, which include prepayments and the judgment that's going to have to be applied as the institution looks at what the options are. If you want to know more about vintage and you want to understand more about the pooling process, you can contact us. We can actually have a chat with you about it. So let's talk about data requirements. This is very important, particularly for smaller institutions that probably don't track a lot of data for any particular reason today other than maybe internal reporting and concentrations. So you're going to need internal data, and by internal data I mean typically we're looking at loan origination information. This information could be on your credit memos, it could be in your pulling of credit information, credit scores, Experian, Beacon, information that talks about the borrower's risk characteristics and the asset's risk characteristics. So a lot of this data is currently not stored in core systems or stored at all by a number of institutions. So we have a list of all the items we think might be required, but right now there is no one recipe that says this are definitely what you're going to need. So, but we think this is the type of information, if you're not storing it now, you need to store it. And a lot of cases it's difficult if you're using one of the less complex core systems. There may not be places to put this. Also, it may be difficult for you to get historical information out. So we think it's pretty important that you start to establish your own credit data mart, which is simply a place to store this information along with balances with monthly snapshots. It may be required to look at your historical loss data in ways you haven't looked at before. This would be typically if you're doing a loan loss reserve now using historical loss rate. What are the pools? What are the rates? You may need to get into more granularity or detail because you may be required to look at specific credits and what their risk characteristics are when they failed. So you can see that this could be difficult, and we know a lot of institutions who keep this information on spreadsheets because they only have 3 or 4 credits maybe that have gone bad in the last 5 years. So it's just important to understand that that's really the basis for a lot of CECL. It's possible you may need some transactional data. By that we mean it may be that certain things like prepayments and changes are not stored in the core on a monthly snapshot, in which case you're going to need to get them off of some sort of daily feed. Probably not a big issue for the population of people here on the phone. Larger institutions may be more challenged in this way. But you also have to worry about external data. If you're going to be doing projections of losses and tying them and justifying them based on economic performance over time, then you're going to have to be able to produce the empirical data that supports your assumptions about your projections of loss. And this is the kind of thing that you might need. Now, this information is typically free and available. One of the things that the ArdmoreFintellix solution is going to include is a lot of this data will be built into our solution so that you can pull this publicly available data directly into your calculations as opposed to having to go off and find it. This is one of the reasons why, for example, you may decide that working on a spreadsheet isn't going to be sufficient because not only do I have to do all these pools and have all this justification with these risk characteristics and try different scenarios, but I'm going to have to pull in this external data. It could be a lot of number crunching to try to do it in Excel, even if you have pretty homogeneous pools. And again, with the projections, you might want to use, Sonny referenced the Dodd-Frank stress test projection information that's available from the Fed. You may want to leverage that. I mean, it kind of makes sense to say, well, if the government's producing it, maybe I want to use it. But we know also the government's been pretty lousy at projecting what's going to happen. They've been saying interest rates are going to go up for the last 5 years, so we'll see.
Audit would be easy though if you were to use Fed projections.
You would think it would help with the audit.
Yeah.
It would be, unless the auditors say, well, guess what? Those are nationally based projections. I'd like to see something reflects your local market in more specific.
All right, local Fed is probably the way to go.
So some questions to think about here is, you know, do you have an in-house core accounting system with all this data in it, or are you using a hosted solution? How much history is there? You might want to contact your provider and say, you know, how do I get to my data? How much did you keep for me online? How many backups do you have? If it's not available, is it something that they have archived somewhere. For a lot of core providers, they may keep, for example, maybe 2 years or 3 years online, and then they archive off the rest. This is something you're going to need to know. And you have to consider where you want to store this data. Can you store it all in your core accounting system? Do you have a data warehouse or data marts where you can capture this? One of the things we learned from doing that cost-benefit study that Sunny referenced was that the cores will charge you a lot. They'll charge a lot, right? So if you don't take control of your data yourself, then you're going to be constantly going back and asking them for files that they're going to charge you for. So you have to really think about how you want to build this out to an extent. For a smaller institution that's not very complex, the data warehouse could be something, an internal data mart that's pretty simple and inexpensive to maintain. There are also tools out there today for hosted data marts, meaning you don't even have to have the database in your shop. Our program, for example, has a hosted data mart in it as well. And again, I mentioned charge-off and recovery data is typically kept in spreadsheets. We talked about the impact of acquiring a portfolio. I think sometimes institutions forget when they do an acquisition that closed loans are going to be required over time as well. And again, integrity of data. How accessible is it historically? If you go back, if you're going to change your pools, how does that impact historical data if you have to have a new methodology? And again, there's going to be costs in the budget for this, so it's something to think about now. Also, just to touch on disclosures, they are going to change, become more difficult to manage simply by the nature of the fact that now we're actually looking back into the underwriting or decisioning of loans, because they're going to have impact on what the charge-offs, what the initial write-downs are. So, for example, if you're making a decision based on some automated process, your auditors may look at this and say, well, you decide to put this loan in this pool that directly impacts your capital because it impacts your provision. Can you justify and disclose why you decisioned it this way? So you can see here on the screen some examples of disclosure guidances that are required. We know there's going to be enhanced disclosures required because one of the whole reasons for this rule was created was that the agencies, the government felt that during the economic downturn, not enough information was available to an investor as to what exactly was going on within the bank's credit management. So a lot of these disclosures are meant to show more transparency in the performance of your credit processes and the performance of your assets. And so there's a lot more required to be shown on a regular basis. Here's an example of a amortized cost basis broken out by origination year. This is right out of the guidance itself. You have to show 5 years of performance and balances broken out by risk grades. For consumer, you have to be able to either create risk grades so that you can show this kind of granularity. So, for example, you may use a combination of delinquency status and credit score to create these sort of breakouts, but they have to be based on risk characteristics shown over a 5-year period.
Just wanted to add quickly here that for this disclosure that's disaggregated by vintage, there is, for the institutes that are not publicly listed, you don't have to do this from day one. You can transition slowly over a period of time to all of these 5 years. So you begin with the data that you have, and over a period of time, you build up the 5-year disclosure.
Right. Privately held institutions can do it for 3 years and then add the 4th
right.
and add the 5th. Here's another example. Here's an example of past due. You can see consumer broken out into credit card, other, and auto, residential, and this is past dues. Again, this is the kind of thing. So there'll be a lot more of this being done. It'd certainly be easier if you had an automated solution that just cranks these things out. But doesn't prohibit you from doing it by hand if that's the way the institution wants to go. So let's wrap up, talk for a few minutes about what you should be doing now and what you should be doing next year, because 2020 is really around the corner, and there's some considerations that everyone needs to think about. As a small institution, which most of you are, it's important that there is communication around what's going on with CECL. So we highly recommend, as an early step, that you get together with the key areas of the bank or the consumer credit union that are impacted by this, and have some communication about how CECL is going to impact. We've already talked about data, so we know your IT groups or your MIS groups are going to be responsible for helping you pull together information that you need. And it includes reporting and data storage and the core. We also know that credit people are going to be involved. We also know that people who originate loans are going to be involved, because their strategies may change based on the way that CECL works. You obviously have finance involved, so you need an interdisciplinary team. Even if in your institution people wear many hats, there's still more than one person who's responsible for this and how it impacts the institution. So from a data standpoint, 5 years of data. So you really needed to start collecting data in 2015. You may have to reconstruct some of this. Most of your cores don't have more than 13 months of monthly snapshots, so you're going to have to start thinking about that, as well as prepayments and recoveries. Peer data. Another thing, again, we intend to have in our CECL release, we already actually have a pilot of this, where you have the ability within the product to create peer data, so you can fill in the gaps for information you don't have on losses. Capital considerations, we talked about the fact that 2020, you have to know January 2020 what the capital hit's going to be, because it's got to be written off. You don't want to be trying to figure that out in 2019 just before it happens. You want to know well before that. So you really need to start thinking about the capital impact and the people involved in the bank who can help. And again, one of the big issues really is audit, and how auditors are going to require more information, more detail, more justification behind how you're doing your estimates, including what we call the Q factors, or those qualitative factors. They're also going to be looking at the underwriting process, as I mentioned before, in more detail. So if you have a very informal underwriting process or decisioning process on your credits, and it's not documented very well, and the criteria for why you would choose to grade or categorize a loan by risk characteristic, we recommend you start looking at documenting those procedures and processes all the way back to whatever the origination or decisioning process is, so that you'll be ready to explain to auditors and the like what it is that you're doing. So what can you be doing now, and what should you be doing now? Right now, really the areas for banks in early 2017, we believe, and credit unions as well, basically any financial institution that's smaller than the $10 billion line for Dodd-Frank, is you really got to be taking a look at your credit data and doing an assessment of what you have, what your gaps are, and what you need to do to prepare. ArdmoreFintellix, we do that service for institutions. We've done that for about a dozen so far, where we come in for 2 days. We take a look at your origination process and decisioning process from the moment that the application is approved to what data flows into your core accounting system, and then where does it go after that for reporting and analytics, and how will it support not only CECL, but other more proactive risk management practices that the agencies are looking at institutions to perform. So right now is a great time, if you haven't done it, to start looking at your processes of creating risk characteristic information, some of the things that we listed earlier in the presentation, and where and who owns it, who's checking it, who's making sure that it's robust and it's consistent, and the criteria around assigning these codes is actually being managed. Look at some of the solutions that are going to be available in the market today. We have ours. There are others out there. You should start thinking about what the impact is going to be for data storage, for the cost of a solution, automation solution, and start to remediate your data. So once you identify your gaps, what we do is we put together a roadmap, basically, that says, from an industry perspective, here's where you look, here's where you rate compared to typical institutions. Here are some areas we think you can address short-term, and here's some long-term concerns. So that by mid-2017, you can start to look at possible automation alternatives as opposed to trying to do this by hand. Maybe looking at solutions like ours and others in the marketplace, such that by 2018, you can actually start running parallel runs with CECL calculations as well as your current calculation. You cannot go early or ease into CECL. You have to continue to do your current process and then make one switch, which is where that capital hit happens. So you really want to be doing that in 2019 at the very latest. You want to be fine-tuning. You don't want to be in the process of trying to figure out how to do it. So it may seem like a long way away, but it's not really that far away to 2020 when you think about the steps that you have to follow. And it makes sense to start now. And that's why, for example, the regulator said that in the Risk Management Association. Is this a small tweak to what you're doing today? Obviously, it varies on the amount of lending you do, the amount of information that you need. Also, this is really more of a marathon than a sprint. So we're going to learn things as they go. Finding out where your resources are going to be. For example, ArdmoreFintellix, working with OnApproach, can do a series of educational webinars as the new regulations and new requirements that come out from the auditors are published. We'll be able to send that information to the clients of OnApproach and ArdmoreFintellix. Make sure you're up to date on what the regulators want and what the auditors want. One other thing to think about before we kind of close here is that there's really some advantage to doing all of this other than just meeting the requirements of CECL. And that is that, let's face it, for most smaller institutions today, there hasn't been a lot of focus on data management and saving this information and using it. A lot of scrubbing is going to be required. So, it makes sense to start assessing what you have and establishing your goals, identifying where your gaps are, and then really trying to work your way to a long-term goal state of having one version of the truth that you can use for CECL. And if you want to get into stress testing, you can use it for board reporting, regulatory reporting. So our view is, create the data once and use it as many ways as possible. So why not use OnApproach's data structure? They can help you out because they have already built out a data mart with all the fields required or that we understand today. And you can start pumping your data to them. That becomes a historical data receptacle that's backed up, it's auditable, it's stored, and then you can hang off of it applications that OnApproach has partners like ArdmoreFintellix for our ALLL. We also have a stress testing program so that, again, this data is being used over and over again and becomes your source of the truth. So to wrap up, shameless self-promotion here, and then we can take some questions. But what we can do to help you is, if you're interested in a data assessment and you don't think you have the resources in-house to do this right now, we do recognize that it's kind of hard to change tires on a car that's moving down the road like most of you are. We can do that assessment for you. It's a 2-day on-site visit, and then we write a report for you. We've done this many, many times. It's well received by the banks that we do it for. They find the reports that we create to be easy to understand, and it really helps align with what the agencies are expecting down the road. We can do that. We also have a credit portfolio management suite hosted software package that will work off of the OnApproach data structure, and in it, it includes portfolio stress testing, not the Dodd-Frank complicated one, but the kind that regulators want small institutions to do, as well as portfolio analytics and reporting for concentrations in the board and management, I guess I should say, for you guys, and also the ALLL reserve with the CECL ready calculations. So we would see the financial institution taking their credit data sources, pumping it over to OnApproach into their into their data warehouse, and then we would take specific information out of that for the data marts that are needed for ALLL, CECL, stress testing, deliver that back to you through our application, through reports and dashboards. Our application is a workflow-based approach. You can have one person who does it from start to finish. You can have a manager who has to approve. It's considered one of the simplest and easiest to use programs because it walks you through the process in a logical fashion and helps automate the heavy lifting. And we use a dashboard sort of approach, which is what you see here. If you're interested in this, please contact the OnApproach people. We'd love to talk to you in some more detail about how this works. And at this point, I guess I would turn this over to Austin if there are any questions from the audience and the people on the call.
Yeah, thank you, Peter and Sunny. That was very educational. The only question that we have today, so far anyway, and please feel free to log in more questions if you guys have any, is that will we receive a handout of this presentation? So the PowerPoint, will you be able to provide that?
Absolutely. Absolutely. You can reach out to us here. These are our email addresses, or you can contact the OnApproach people who will contact us, and we can fire this out to you.
Great. And we'll also be sending out a thank you email after this to all the attendees that joined here today. And in that, we'll include that PowerPoint presentation as well as a link to the recording of this webinar as well. So with that, I don't think we have any additional questions, but after that thank you email comes in, I think a question might have just came up.
Sure. And we're available to do some webinars. If, for example, you think this information is important for your management to understand and you'd like to have us do that, we can get together a group and do a webinar similar to this with maybe a little more detail where we can show you examples of the kinds of solutions that are available today. So, well, thank you. If there are no other questions for ArdmoreFintellix from Sunny and myself, we appreciate your time and attention. OnApproach, thank you again for your support, and we look forward to working with really with the entire community here.
Excellent. Yeah, thank you both. Thank you everyone for attending. And like I said, we will be sending out a thank you email shortly here after this. So if you guys do come up with any additional questions that you weren't able to think of during this webinar, that's a good opportunity to ask those questions, and we can pass those along on to Peter and Sunny if they don't pertain to something that we could handle on our own. So, oh, another question might have came up here. Oh, nope, just a thank you. All right. So with that, thanks again, everybody, and have a good rest of your week and good rest of your day.
Okay. Yes, thanks a lot.
Thank you.